The following content has been generated with artificial intelligence under minimal human supervision. The data presented may contain errors or inaccuracies. The opinions expressed in this content do not necessarily reflect the vision, position, or values of Digi-all. We recommend verifying critical information with additional sources before making decisions based on this content.
Welcome to Digi-all Tech News. Today is Saturday, February 7th, 2026. I'm Kylie Brooks, and this is where technology becomes clear and engaging. Goldman Sachs partners with Anthropic to deploy Claude AI as digital co-workers for accounting and compliance automation. Tech giants' AI spending could approach $700 billion this year, severely straining free cash flow across the industry. AI investment trade fractures as investors become more selective, with hardware makers outperforming software companies in the latest market shift. Stock futures stabilize after tech rout as Amazon slides on AI capital expenditure increase of more than 50%. Google and Microsoft pay creators up to $600,000 for multi-month partnerships promoting AI tools on social media. Let's start with what could be a game changer for how financial institutions operate. Goldman Sachs is partnering with AI startup Anthropic to create autonomous agents powered by Claude. For the past 6 months, Anthropic engineers have been embedded at Goldman, working on systems designed to automate time-intensive back-office tasks, like accounting for trades and transactions, as well as client vetting and onboarding. Chief Information Officer Marco Argenti calls these agents digital co-workers for complex, process-intensive professions. This isn't just about efficiency. It's part of CEO David Solomon's multi-year plan to reorganize the firm around generative AI, which has allowed Goldman to constrain headcount growth despite surging revenues. What's particularly interesting is why they chose Claude. Initially, Goldman tested an AI coding assistant called Devin, but they discovered Claude's real strength in reasoning through complex problems. It's about parsing data, applying rules, and exercising judgment in accounting and compliance scenarios. Argenti highlighted Claude's ability to reason step by step, questioning whether this capability stems from its coding nature or broader logical abilities. The implications are significant: faster client onboarding, quicker resolution of trade issues, and potentially even applications in employee surveillance or creating pitch books. While thousands work in these areas at Goldman, it's too early to predict job losses, though the firm may reduce reliance on third-party providers. The announcement comes as Anthropic's model updates have triggered sell-offs in software sectors, adding another layer of complexity to this AI transformation story. Now, about those massive spending numbers. Alphabet, Microsoft, Meta, and Amazon are collectively forecast to spend nearly $700 billion this year on AI infrastructure. That's a surge of over 60% from last year. We're talking expensive chips, new data centers, and cutting-edge networking technology. But here's the catch. This investment is severely straining free cash flow, which for last year, 2025, was projected at $200 billion for the group, a decrease from the $237 billion recorded in 2024. Amazon's situation is particularly striking. The company anticipates negative free cash flow between $17 and $28 billion, which might require equity or debt financing according to their SEC filing. Alphabet could see capital expenditures hit $185 billion this year and $250 billion next year, slashing free cash flow by nearly 90% to just $8.2 billion. Meta is planning $135 billion in capex, with free cash flow plummeting almost 90% and potentially going negative in 2027 to 2028. CFO Susan Lee emphasized this is about AI dominance. Microsoft spending grows more gradually, with a 28% free cash flow dip, before rebounding in 2027. Despite these challenges, the firms hold over $420 billion in cash. Analysts remain optimistic, viewing AI as a trillion-dollar opportunity fueled by enterprise compute demand. Strong returns from Google Cloud, YouTube, and AWS provide some reassurance, though risks from competitors like OpenAI persist. As Longbow Asset Management CEO Jake Dollarhide notes, if you're going to pour all this money into AI, it's going to reduce your free cash flow. Year to date, the market has responded with mixed results. Amazon shares fell 9%, Microsoft 17%, while Alphabet and Meta edged up slightly. The global AI investment trade is fracturing as investors get more selective. This division is evident across stocks, sectors, and regions, which contrasts sharply with the broad surge we saw after ChatGPT's November 2022 launch. Back then, everything rose from chip makers and software firms to suppliers, and even companies being disrupted by AI. That enthusiasm drove equity and debt markets to what some called bubble-like heights, fueled by hundreds of billions in planned spending by the tech giants. Recent market turmoil signals a pivotal shift. Investors are now balancing AI's promised benefits against its escalating costs. Hardware makers enabling AI data centers, the so-called picks and shovels, are outperforming software and analytics firms lower in the value chain. In the US, ServiceNow and Salesforce fell 12% and 9% this week. In Europe, RELX and LSEG dropped 16.4% and 6.3%. Saxo's Charu Chanana notes this divergence differentiates AI enablers from those potentially being disrupted, with Barclays highlighting extreme dispersion in Europe. Even the Magnificent Seven stocks are diverging. Microsoft shares plunged 10.4% despite higher capex. Meta rose 10%, Alphabet dipped up to 8%, and Amazon fell 8.5% after announcing a 50% capex increase. Mark Horton of Lion Trust predicts the group may underperform without clear returns on spending. Interestingly, South Korea leads gains on AI memory demand, with the cost buy up nearly 21% year-to-date versus a 0.5% S&P 500 decline. Samsung and SK Hynix rose 32% and 29% respectively. UBS's Jerry Fowler attributes this to a heavy shift toward memory in the AI capex trade, with 20% inflows into US-listed Korean equity funds in January, according to Morningstar. Yesterday, US stock index futures steadied following a severe sell-off in technology shares earlier in the week. Amazon became the latest big tech firm to ramp up AI spending, causing its shares to slide 7.8% in pre-market trading. The e-commerce giant forecast a more than 50% increase in capital expenditures for the year, intensifying investor concerns over the Magnificent Seven companies' AI infrastructure investments. Skepticism has grown since Microsoft's late-month announcement of substantial capex plans. While Nvidia, positioned to benefit from AI spending, rose nearly 2.7%, software and data services stocks showed signs of recovery after a tough week. ServiceNow and CrowdStrike gained 2.9% and 2.1% respectively, though the S&P 500 software and services index faced a nearly 10% weekly decline, its worst since March 2020. Analyst Ryan Lee noted limited tolerance for unchecked capex without clear monetization strategies, placing Amazon, last year's weakest Mag 7 performer, in a vulnerable spot. Alphabet dipped 0.7% while Microsoft rose 1.6%. The Nasdaq closed at its lowest in over 2 months amid a broad tech rout, heading for its steepest weekly drop in more than 10 months. Chip makers Broadcom and Micron rose over 3.3% each, while the VIX fear gauge fell 1.31 points to 20.46. The S&P 500 ended at its lowest in over 2 weeks, set for its worst week in 4 months. The AI-driven rally now faces stress, with funds shifting to defensive sectors like consumer staples and telecoms. Bitcoin dropped 50% from its October peak. Small and mid-cap indexes were up about 1% weekly, and Roblox surged 16.4% on an upbeat fiscal 2026 bookings forecast. Finally, let's talk about how AI companies are winning hearts and minds on social media. OpenAI, Anthropic, Microsoft, Google, and Meta are increasingly partnering with social media influencers to promote their tools through sponsored content on platforms like Facebook, Instagram, YouTube, and LinkedIn. These firms have ramped up advertising significantly, spending over $1 billion on US digital ads in 2025, a 126% increase from the previous year. Google and Microsoft's AI-related ad expenditures surged about 495% last month versus a year earlier. The deals are substantial. Microsoft and Google are offering $400,000 to $600,000 for multi-month creator partnerships. Individual posts can fetch $5,000 to $30,000, and top influencers charge up to $100,000 per post. Anthropic has been particularly proactive. They appointed Lexi Barnhorn in March to head influencer marketing and secured deals with creators like Megan Liu, who has nearly 400,000 followers. Lowe promotes Anthropic's Claude AI on LinkedIn, praising its agentic capabilities for programming. AJ Eckstein from Creator Match reports a massive increase in creator spend as AI brands seek authentic endorsements to build user trust. Partnerships often extend beyond posts, offering early access to tools, event invitations, and travel perks. However, some creators decline due to ethical concerns over AI's impact on jobs and creativity. A Pew Research survey shows half of US adults are more worried than excited about AI. Influencer Jack Lapierre, with 7 million followers, rejects offers up to $500,000, arguing that generative AI threatens livelihoods for everyday artists and workers. It's a fascinating tension between marketing muscle and genuine concerns about AI's societal impact. So that's where we stand this week. Goldman Sachs betting big on AI automation, tech giants pouring unprecedented capital into infrastructure, while investors grow more cautious, and companies spending millions to convince us all that AI is the future we want. The numbers are staggering, the stakes are high, and the questions about returns and impact remain very much open. We'll continue following these developments as they unfold. Thank you for staying informed with Digi-all Tech News. We'll be back with more updates as they develop.